time is more important than price itself. If you struggle with understanding time, then you will forever be gambling in the markets. The understanding of time alone is what will likely bring you to profitability if you are not already there. Time is the most important factor. Well, time and timing itself are the most important factors when considering an entry. More specifically, time is the most important factor to win a trade. Let's get into this presentation. Why is it so important? Why is time so important? Well, you need to understand that the markets are controlled. And as ICT has said, there is an algorithm controlling these markets. Whether you are trading Forex, futures, commodities, whichever market asset, whatever you are trading, is controlled by an algorithm. What are these algorithms? If you might be asking yourself, is this some voodoo nonsense that ICT just preaches? The answer is no. Hedge funds and central banks, specifically central banks, spend billions of dollars on programming every single year to allow these markets to function at a normal pace. This means that targets, highs and lows of candles are predetermined before they print. Next week's high and low is already predetermined. Next year's high and low is already predetermined. Time is fractal, keep that in mind. There are key times where an algorithm changes program. If there is an algorithm, then time is important. That is applicable to anything in life, not only the markets. Every single algorithm is based on time. Every single program is based on time. Program starts, something occurs. Program continues on. At a specific time, the program changes, not random, but at a specific time. This allows for effective markets. If there was no algorithm controlling the market, then outsiders would be able to come in and crash everything. This is not random and therefore can help you locate higher probability trades. If you can find where the algorithm changes program, aka reversal, then that will help you locate the higher probability trades. Keep in mind that specific signature happens at a specific time of day, of week, of year. Trading without time in mind is like trading with a blindfold. You are simply gambling if you do not trade with the thought of time in your head. Some traders, some successful traders, actually trade time without even knowing it. Reversals occur at specific times. Understanding those times are key when wanting to catch an entire leg. 9 a.m. is one of those times. So there are divisions of time, as Romeo mentions. The open, high, low, and close is the first division. 70% of the importance of time lies in the open, high, low, and close, or open, low, high, and close. The rest is placed in the IPTA data ranges. I have talked about those in my YouTube videos. Specifically, I went in depth on the IPTA data ranges within the Turtle Soup Masterclass posted on my YouTube. Now, besides the IPTA data ranges and the open, high, low, and close, we have the squares of time. These squares of time basically help you understand what specific day of the year to expect something to occur. Turtle soup. And lastly, we have time itself, right? So understanding the quarters of a candle. Anyways, let's get into the open, high, low, and close. These two candles are very basic, and these open, low, high, and close, and open, high, low, close candles show you the power of three very clearly. This would be considered almost an A+ setup. A bullish candle will open at the lower end, right? Open. Manipulate lower. Turtle soup. Find your entry model below the candles open when bullish. Entry long. Expansion upwards. This is the lower time frame of this specific higher time frame candle. Understanding how the lower time frame of a candle understanding how a lower time frame of a candle works and functions is going to be key to your success. Pick a specific candle, a specific time slot of the day, and master it. Form different profiles and kill zones within that candle. The same goes for a bearish scenario. Price opens, manipulates above the open. Turtle soup, a high. Find your entry model above the candles open if you are bearish. Expansion lower. So open, high, low, and close. That is a bearish situation. And open, low, high, and close for a bullish situation. Now, keep in mind, not every single candle forms this way. There are 6 different ways that a candle can form, and only 6. I do not take credit for this image. This is directly from Romeo himself. There is no use for me to replicate this image. I give credits to Romeo for this image. First candle. Well, firstly, there are 6 ways that a candle can print, as I have just said. These are all 6 ways that a candle can print. First is a classic buy candle. Price opens, manipulates lower, find your entry below the open when bullish, expansion higher, coming back down in closing. So open, low, high, close, open, low, high, close. A bearish classic sell candle. We open, create a high, turtle soup, a range, low, and close. Open, high, low, close. Same thing as the same thing as the classic buy candle, however, in a sell scenario. We have a bullish consolidation candle. In this specific candle, you will be playing the range. Turtle soup, range high, turtle soup, range low. You do not want to be focusing on CRT when the higher time frame candle is forming like so. You'll be trading the range. Same thing in a bearish scenario. So price opens, creates highs and lows, and then closes above the open and that is what allows this to be a bullish candle. Instead, in a bearish scenario, the price opens, creates highs and lows, ranges, consolidates, and closes lower than the open. This is bearish. We then have a bullish reversal candle. Price opens, digs deeper with speed, purging a low, hitting a key level, and expanding back up, and then closing above the open. So we open, create a low, a high, and close, open, low, high, and close. Same thing for the bearish reversal candle. Open, high, low, and close. These formations or profiles form on all time frames. Try to determine which candle is going to form at a specific time of day before the actual formation. Your goal is to study a single candlestick from the lower time frame in order to understand where is the best possible entry. If you pick one candlestick, for example, let's go ahead with the 9 a.m. 4-hour candle, and backtest and front test the 9 a.m. 4-hour candle every single day. You will notice that one of these 6 formations or profiles actually form within the 4-hour candle. Your goal is to create your own kill zones within the 4-hour candle. Guys, what I am explaining to you right now is going to allow you to create your own personalized, customizable model that is designed for your success alone and no one else's. Meaning, there is a high likelihood that no one will have the same model as you. You will backtest a specific candle on the lower time frame while actually paying attention to the higher time frame candle formation, and this will allow you to study in a manner that the professionals do. We use higher time frame candles to base our direction of the market. So building a model around time, not price. The hedge funds, the market makers, they do not trade price. They trade on time. There are quarterly shifts. ICT mentions this a lot. These quarterly shifts are completely controlled and decided by whom? The market makers. Why quarterly shifts? Why not? Why wouldn't they act when a price hits a certain level? Why would they act only in quarterly shifts? Because they run on time. So what is a time-based model? The model works by looking at a special time period first, and then watch how the price moves during that specific time. What does this mean? Well, firstly, it's like a game where you watch the clock first and then you look at how the numbers change during that time. Let me simplify once more. A time-based model is basically you choosing a specific time period, a specific time slot throughout the day. Let's say it is the 9 a.m. 4-hour candle. That is a 4-hour period that begins at 9 a.m. And then studying how price moves during those 4 hours. This applies to a specific monthly candle of the year, a specific weekly candle of the month. Distribution is usually the third weekly candle of the month. A specific daily candle of the week. Mondays, Tuesdays, and Wednesdays have a high likelihood of printing the high and low or low of the week, a specific hourly candle of the day. We will learn that there are two very high probability day trades every single day. This occurs at a specific hourly candle of the day. Mastering a time-based model means choosing one specific time candle, so a specific timed candle, and getting really good at understanding it or reading it. How do you read it? You pick a higher time frame candle, you square it off, draw a rectangle around it, extend it. So let's say you choose a 4-hour candle, extend it 4 hours, and read the price over and over and over again. Choose a specific 4-hour candle and master it. Choose a specific daily candle and master it. If you want a specific daily candle to master, choose the Tuesday. That is a little tip. If you want a specific 4-hour candle and you are only able to trade the London session, focus on the 1 a.m. candle. If you can trade both London and New York, focus on the 9 a.m. candle. Trading during every session is a type of time-based trading as well. A session is timed. Therefore, you are trading based on time. In fact, all trading is time-based. It just depends on whether you are paying attention to the timing or not. And those who are not paying attention to the time are simply gamblers. Those who trade during the lunchtime, meaning during the 12 o'clock hour, are simply gambling because they have no sense of time. In every session of the day, there is a specific time where your entries become higher probability. In each of the kill zones that ICT teaches, there is a specific time where the setup, the entry model, the reversal, the retracement becomes higher probability. So here's a look into the daily candle right here on the right side of the screen. We have a representation of the daily candle. The daily candle is divided into 6 separate 4-hour time blocks. Every single block over here represents 4 hours. This is the 1 a.m. candle, the 5 a.m. candle, the 9 a.m. candle, the 1 p.m. candle, the 5 p.m. candle, and the 9 p.m. candle. When you hear 159 relating to CRT, this is what they are talking about. This is what they are referring to. Once you understand the image to the right, you realize that you can create any kill zone that you want. They are completely customizable. This is something that many ICT traders, mentors themselves do not mention. The kill zones are customizable. The 5 p.m. kill zone is a real thing. Yes, it is. And even Romeo mentions it. You can forget about 9 p.m. because it is usually consolidation. Every 4-hour period has a high probability model waiting to be executed. Choose a specific 4-hour time block and master it. Keep the open, high, low, and close of the daily candle in mind when trading the 4-hour time block. For example, if you choose to backtest and front test the 1 p.m. candle, 1 p.m. 4-hour candle, and the daily candle has created a low and is currently expanding upwards, you should not be bearish, as price will open, create a low, then create a high, come back down and close. Meaning if the 1 a.m. candle ranged, the 5 a.m. candle dipped below the range of the first candle. 9 a.m. candle reversed back up. The 1 a.m. candle will potentially create a small retracement turtle soup, allowing you to get in long, and you can target the higher draw on liquidity. Each of these 4-hour time periods is a kill zone in itself. The weekly day trading wisdom. Every single day you can find 2 very high probability trades at 1 a.m. and 9 a.m. I want everyone to study this. Study what happens at 1 a.m. This is for Forex, by the way. Study what happens at 1 a.m. and study what happens at 9 a.m. This means that every week there are 10 high probability trades to be taken, if you can find them. Sometimes they are not as visible as you would hope they would be. That is fine. You need patience. Trading is like waiting for the next bus at a bus stop. If you miss the bus, there is no worry. There is another bus coming, meaning tomorrow the candle will open again. Another opportunity arises every single midnight. The probabilities drop for these times, but they are still good, meaning at 5 a.m., 1 p.m., and 5 p.m., the probabilities of your trade working out drop comparing to 1 a.m. and 9 a.m. However, they are still good quality. As I said before, 9 p.m. is usually consolidation. Therefore, you should ignore it. Ignore the 9 p.m. 4-hour candle. Considering all of this in mind, this means that you have 25 good quality trades waiting to be executed upon every single week. A little tip for you guys is that the markets will consolidate for 70% of the time. Let's take a look at a weekly short-term trading wisdom. This is not a day trade. These are short-term trades. There are 2 really good short-term trades you can make every single week. One happens when the price is at its lowest point of the week, usually on Mondays, Tuesdays, or Wednesdays. The other happens when price is at its highest point, usually on Thursday or Friday. That is trade number 2. I want to mention something. Of course, in a different scenario, if price is at its highest point at the beginning of the week, it will create the high and not the low. Same thing with trade number 2. You need to know when Monday will create the high and when will Tuesday create the high. A lot of traders get confused here. Where is the draw on liquidity? If Monday creates a low and the draw on liquidity for the entire week is much higher than where we are, and you see a reversal pattern on Monday, meaning we hit a key level on Monday, you see a bullish CRT form, there's a likelihood that Monday has just created the low. Keep in mind, this reversal needs to happen at a specific time to be considered. Here's another tip. Wednesday cannot form the high and low of the week. It can only form one if it does. This is extremely rare to happen. Meaning if Wednesday creates the high and low of the week, you just witnessed an extremely rare scenario. And that usually never happens. What does happen is Monday, Tuesday, or Wednesday will create the high. In this scenario, Tuesday created the high of week, whereas Thursday, Friday will form the opposing end of the range. In this scenario, it is Friday. Classic accumulation, manipulation, distribution downwards. Why did Monday not form the high, but Tuesday formed the high instead? Why did Thursday not form the low, but Friday formed the low instead? These are questions you need to be asking yourself when you are backtesting. What do you need within a time-based model? Your progress is going to be divided, and it's going to happen in two separate stages. So this is basically how you practice, backtest, forward test, do all of your mastering. Most traders will never make it past stage 1. Why? Because they are lazy. Do not be lazy. Do not complain. Stage 1, picking a specific time frame and sticking to it. You do not strategy hop. You do not look at different time frames. You pick one and only one for now. Picking a specific time of the time frame selected. So time of day, day of week, week of month, depending on what you prefer. So a specific time frame could look like the 4-hour time frame. A specific time of the time frame selected could be the 9 a.m. 4-hour candle. You will have two sets of data to fall upon, meaning you will have your backtested data of at least 1 year. 5 to 10 years of data is better, however, not necessary. And number 2, the second set of data, you need at minimum 3 to 6 months of forward testing data. This is where the importance of the lower time frame practice comes in mind, and is the data which will make you comfortable and ready for the real-time live market conditions. Backtesting will not prepare you to execute in real time, however, forward testing will. Forward test for at least 3 months and then start trading live. Once you obtain the aforementioned sets of data, stage 1 is complete and you are ready for stage 2. Stage 2 is kind of a repetition of stage 1, but seen a different way, seen in a different approach. Stage 2, forward testing the model that you have created for 3 to 6 months. That is, like we said in stage 1. Once you find your favorable results, you are 49% done. The remaining 51% depends on you, the trader. Are you disciplined? Do you have the right mindset? Are you going to be impulsive? Are you going to hesitate? That is all dependent on you. Do you have outside problems affecting your decision making when you come to the markets? If you do, the simple answer is to stay away from the markets. Take a day off. It never hurts, does it? Ask yourself, if there is no lack of information, both free and paid, then why do 95% of the traders out there still lose? This is a very important question. Why is it that 95% of traders, maybe I think it's closer to 99%, but let's say 95% on the optimistical side. 95% of traders lose. They never become profitable. And if they do, they lose it all very quickly. But there is no lack of free information and paid information. So why do they still lose? Because the real edge, the big edge, the most important factor is not in the strategy. It is not in the model. It is you. You are the edge. The mindset that you have when coming into the markets is the edge. For those of you who understand this, you have probably heard about Mark Douglas. You can literally flip a coin every single morning saying long or sell. One side of the coin is long, one side of the coin is short. You can flip the coin every single day. With the right mindset and discipline, you will make money. That is a quote from Mark Douglas himself. You simply play with the probabilities of time in that situation. Here's an extra tip. So since we are talking about time, I want to mention some more things about time. Remember when I explained 9 to 9:30 accumulation, 9:30 to 10 manipulation, 10 to 10:30 distribution? This is not random. In fact, this is based on a specific time slot. Not a conventional time, so one would say. For those of you who are bored, try putting a 90-minute time frame as your custom interval on TradingView. See if anything interesting to you stands out. Where each candle is 1 hour and 30 minutes. This right here is 1 hour and 30 minutes. I need to explain something quickly before we end here. If you divide the 1 hour and 30 minutes into 3, it becomes this explanation right here, these 3 points. Now, if you are looking at a 4-hour candle like so, the 1 a.m. 4-hour candle, you can customize the kill zones to whatever way you want. Meaning, in the 1 a.m. 4-hour candle, there's accumulation, manipulation, distribution. Figure out which time slot of the 4-hour candle, meaning if it starts at 1 a.m., is it 1 a.m. to 2 a.m. accumulation, 2 a.m. to 3 a.m. manipulation, 3 a.m. to 4 a.m. distribution? I just made that up. That is not the correct answer, but find the correct answer and study it. That is all. It is time to get to your charts. This was a shorter chapter, but very important. This will basically allow you to create your very own model. Literally your very own model. Yes, it can help you refine your current models that you are testing, but it is a lot better to create your own model and stick to it. The next chapter will be interesting as I will be revealing models themselves. It's going to be a fun one. For now, good luck everyone. Go start backtesting everything that you've learned so far, and we'll talk tomorrow. Thank you.